Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to another one of our sample trade videos. This one, a real-life example with Rambus Inc. listed on the Nasdaq exchange under the ticker RMBS. Now, this is a 1-month defensive cash secured put trade taken from, of course, our premium stock report. I initiated this trade on September 22nd, 2025. It expired this past Friday, 10/17/2025. So today is the 21st of October in the afternoon. So it expired a few days ago. All right, and this was a defensive trade. As I said, I've been doing mostly defensive trades for the last several months because of my overall concerns for the economy. And that's one of the beauties of these low risk option selling strategies of covered call writing and selling cash secured puts, because we could still make money and set up our trades in a very defensive posture, which is what I did here. All right, let's get started. Let me show you why I selected Rambus on the 22nd of September. This is a little screenshot of our 9-page weekly stock screen and watch list. You're seeing the section that shows Rambus. I highlighted this for you in the yellow row over here. And you could see at the time Rambus was very bullish because it's in bold. That means the technical indicators were all bullish. It was ranked number 7 on the IBD 50, meaning that it has a lot of strength both fundamentally and technically. And it's in the chips industry at the time was ranked A, and the previous week also was ranked A. Now, the on-balance volume was the only slightly negative signal. You could see a down arrow here, which means more cash had been flowing in on down days than on up days. But everything else was so fantastic that I decided to make this one of the securities in my multiple option portfolios. Now, if we move over here, you could see that the implied volatility, 52.8%, which is more than triple that of the S&P 500. These are pretty good, matter of fact, very good for short-term option selling because it gives us a lot of flexibility. We can enter our trades, generate significant income, and still establish our trades in a defensive posture. Now, there was adequate option liquidity, which is, of course, very important for our favorable trade executions. The earnings date did not get in our way, and this security at the time was on our watch list for 12 consecutive weeks. So really, really strong stock. That doesn't mean it can't go down, and as you see, it did. But I'm taking a defensive posture, so I will have quite a bit of wiggle room to the downside. Now, I want to show you now a 3-month price chart of Rambus versus the S&P 500, and you don't have to be Albert Einstein to see, this little orange arrow is that it had been dramatically outperforming this blue line on the bottom, which is the 3-month price movement of the S&P 500. So a very huge discrepancy in a favorable way for Rambus at that point in time. Now let's look in a little more detail on technical analysis. And here you have the 4 technical indicators that we use in the BCI methodology. Number 1 is trend, moving averages. Now, I don't use simple moving averages. I use exponential, which gives more weight to the more recent pricing. And number 1, this blue line over here, is the 20-day exponential moving average, shorter term. You always want to see that over the longer term prices, the red line, the 100-day EMA. So you want that. You want uptrending moving averages, which we do have. You have the shorter term above the longer term. You could see in this black circle over here, the favorable crossover of the shorter term above the longer term. Bottom line, number 1, trend, bullish. Number 2, the MACD histogram, which are these blue bars over here. Those are trend and momentum indicators, and you could see it's above 0 and ascending, quite a bullish signal right there. Number 3 is the stochastic oscillator, which is another momentum indicator. And, once again, it's ascending, bullish signal there. Now, is volume holding up, making these other indicators meaningful? You bet, where this purple arrow is showing very strong volume. All in all, a very bullish price chart. All right, now let's talk a little bit about the put option chain on 9/22 when I entered this trade. And we look at the deep out of the money, much lower than current market value, $90 put strike, which had a bid price of $1.30. Right now, I did 3 contracts of obligation, so that generated $390 into my cash account when I entered my trade. That was my starting point. Now, of course, I'm contractually obligated to buy 300 shares of Rambus at $90 if the option holder decides to exercise, which would mean that Rambus would have to go down in price all the way down below 90 to make that happen. All right. So the important takeaway here is that deep out of the money puts can offer significant protection to the downside. You'll see that in the next slide, while still offering significant initial time value returns. So here's our BCI trade management calculator in action. And you can see that at the time I entered this trade, Rambus was trading at 104.90, and the 90 out of the money put generated $1.30 for 300 shares of contract obligation. Now, the spreadsheet lets us know that if taken through expiration, which it was, it's a 26-day trade, right? Now, take a look at the break-even price point where this red arrow is, 88.70 from current market value of 104.90. It would have to fall all the way down below 88.70 before we would lose even 1 penny. That shows you the protection. What about the money? Because this is all about making money, folks, let's face it. Well, based on a premium of $1.30, we get a return of 1.47% based on a 26-day trade, annualizes out to 20.57%. Now, should Rambus drop below the 90 put strike, and we take no action to buy back that put, then we will purchase Rambus at the break-even price point of 88.70, which represents a discount of 15.44% from the time we entered the trade and Rambus was trading at 104.90. That's it. Either we generate a 20.57% annualized return, or we buy Rambus at a discount of 15.44%. Now, of course, if it drops below that break-even price point of 88.70, we could start to lose money. So these are not no-risk trades. They are, in fact, very low-risk trades. All right, here's a broker confirmation of the 3 contracts. The $90 put you see here, the expiration of 10/17, and the $1.30 times 300 that I executed on trade initiation. So what did I collect? $390, less $1 and change of commissions on the options contract. Now, the spreadsheet also gives us a total portfolio. I just made it so it's easy to see, 1.47%, annualizing out to over 20%, and a protection to break even of 15.44%. All right, so what happened? On expiration Friday, Rambus was trading at 96.26. Ladies and gentlemen, that was down $8.64 a share. If you just bought Rambus when we entered the trade, you'd be losing about $2,600, something in that neighborhood. But we didn't. We sold the deep out of the money put, which at the time was actually above that deep out of the money $90 put strike by $6.26. And it was above the break-even price point of 88.70 by $7.56. So what happened? We did realize our max profit of $390, 1.47, 20.57% annualized return. And you could see here that Rambus, even though it had gone down so much, 864, at no time during this monthly contract did I break a sweat. Was I worried about losing money? At no point in time. Now, if it had gone down a lot more than that, yeah, that would be a different story, but I'd be prepared with my exit strategy arsenal. That was not necessary. So to summarize, significant returns can be generated with a 26-day defensive cash secured put trade. And we can craft these trades to align with all market environments and our personal risk tolerance. I told you at the onset that, I'm a little concerned about the market. So I've been crafting my trades defensively. You may be more aggressive, or you may be even more defensive than I am. There's no right or wrong, right? But what we teach is how to do it based on your overall market perception and your personal risk tolerance. So in this particular case, I did max out on my Rambus trade. Once again, let me reiterate, these are not no-risk trades, not at all, but they are in fact very low-risk trades, particularly when you craft it the way I crafted this one. So ladies and gentlemen, that ends another one of our sample trade videos, this one with Rambus Inc., a successful trade. I will show you losing trades when they come up, I promise. But fortunately for me and my family's portfolio, not many have occurred since I started taking on these extremely defensive trades the last several months of 2025. Folks, I hope you enjoyed this video. I hope you benefit from it, and I appreciate you taking the time to watch it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.